Welcome to Wealth Wednesdays. We go live 12 p.m. every single Wednesday, Eastern Standard Time. I'm Seth Ferguson. Really happy you are joining us today. We are talking about recessions because a recession is coming or it's already here. Whether or not that's the case, it doesn't really matter. What really matters is what you are going to do with the opportunity that it presents you in the next 6 months. How are you going to invest your money to take advantage of the opportunity the market is giving you? My very good friend, Urban Cito, is joining us in a little bit. But first, I want to talk to you a little bit about framing the market, framing the situation right now. What is the opportunity that is at hand? So companies are pausing hiring right now. We've seen a whole bunch of major companies are pausing. Office space is in trouble as a whole entire sector. That's softening up as more units are coming online. But there's uncertainty in the marketplace. The media is doing their thing, and whatever happens in the market, there is opportunity. So Warren Buffett has a really great quote. He's like, be fearful when others are greedy, be greedy when others are fearful. And that fear meter is starting to tick the other way. So now we have to start opening our eyes and figuring out, what are we going to do? What are we going to create with the opportunity the recession is giving us? The USA, the United States, is already in recession. They hit that marker in the summer of 2022. Canada is likely going to be there very, very soon. The yield curve is inverted. And whenever that happens in Canada, a recession follows 60% of the time. So let's head over to the whiteboard. I want to draw a couple things out for you guys right here. So I was looking at some stats the other day, and I found some really interesting things. So let's first draw out the yield curve. So the yield curve kind of looks like this. I'm going to try and do it as best as I can. And then we've got down here. Okay, so this is the current state of the yield curve, and we've got, this is short-term bonds right here. This is longer-term bonds. If you're not sure what yield curve inversion means, it's the way the market is looking at the future and valuing risk. So typically, a shorter-term bond, a 2-year bond, is cheaper than a long-term bond because the market knows that in the short term there's less opportunity for things to go wrong. It's a shorter time frame. I'm more confident in the short-term prospects of the economy rather than the long-term prospects. But when the yield curve inverts, that means that the market is pricing the long-term bond cheaper than the short-term bond. So the 10-year is less expensive than the 2-year. And generally, like I said, in Canada, a recession follows 60% of the time. So like I said, the US is already in recession. They hit that marker in the summer. And, the saying goes in Canada, when the USA gets sick, Canada catches a cold. So whether or not we're already in recession, you can debate that point. But the fact is that something is coming. Choppy waters are ahead for Canada, and that's going to present a whole lot of opportunity for investors, whether it's in real estate, whether it's in stocks, whether it's in private equity, you name it, there's a whole lot of opportunity coming. So one of the things I really wanted to focus on today was 2008. That's the Great Recession, the big one, probably the biggest one, that we will see in our lifetimes, and how everything reacted, how different segments of the population, depending on what they were investing in, what they were doing, how it impacted them and their wealth, coming out of the recession in terms of recovery. Because until I started looking at the stats into this a couple days ago, I didn't really understand the full impact of what you're investing in, what you're doing with your money, and how that really impacts your net worth coming out of a recession. So we'll just call this the average American household. So average right here. They lost 25% of their net worth in the Great Recession, in the 2008 crash. That's huge. A quarter of your net worth, poof, gone. But then when we look at the top 20%, the top 20% only lost 14% of their net worth. So almost double in terms of the average American household. So the top 20%, they were doing something different with their money. They had a different strategy. They were thinking about money a different way because, they took a 14% haircut. That might seem bad, but compared to 25%, that's not bad at all. So what are these people doing differently than the average American household where they lost 25% of their net worth? Now, this is where things got really interesting because it's one thing to look at, how things are, when the market's sliding down, but the recovery is what really matters because that's where a lot of people made their money. So let's fast forward to 2015. Okay, so we'll fast forward 2015 here. So in the years between 2009 and 2015, this is what really opened my eyes. So the top 1% in the USA, their income grew 37% between the years 2009 and 2015 in the recovery following the recession. Now, everyone else, the other 99%, all lumped in together, their income only grew 7.6%. I think that's staggering. This was a big eye-opener for me. Losing a quarter of your net worth versus the 14% of the top 20%. But this is the big eye-opener. Coming out of the recession, the big recovery, 37% increase in income for the top 1% of Americans, and only a 7.6% increase for everybody else. And then when you really, divide those numbers up as you keep going down, the lower you go, the less and less and less it gets. So, what were the top 1% of people doing that everybody else wasn't doing? Well, and let me erase this right here. They were investing, they were using their money a lot differently than everybody else. So the wealthiest people, they were invested in three main categories. So they had securities, they were invested in stocks, and they had business equity. So when you look at the graph, and these charts are really interesting. So when you look at the top 1% of investors, what were they doing with their money? Let's say this is the bar chart right here. So you'd have their income coming in, the regular income. Now about half of it, give or take, depending on the segments you look at, this was the investment side. So this is where you get the securities, the stocks, and the business equity. So securities, that can be, whether it's commercial real estate, it can be other types of investments, private equity. Then you have stocks, and then you have, business equity, like businesses that they own. So almost 0.5% of their total income or their total net assets, their net worth was made from investments. This part was active income down here. Now, when we go over to everybody else, your typical middle-class home, you have a sliver right here of investments. And then everything else is active income. So this is where you get the huge disparity in coming out of the recession and into the recovery phase of the market. So the rich people had investments, they had assets that they owned. This is the key between the 37% increase and the 7.6% increase. So rich people, we know, have assets, and it worked out hugely, heavily in their favor. So I've got a couple other stats I really want to share with you guys. So the middle class, during 2008, the Great Recession, the middle class, it turns out they were 7 times more exposed to the housing bubble and the collapse than the wealthier families. So 7 times. Now you have to ask yourself, why? Because the rich people, we know rich people invest in real estate. Like that makes up a big chunk of their portfolio. And that comes in the forms of securities right here and other real estate they own. But why is it that the middle class, the average family right here, where they lost a quarter of their net worth in 2008 and their net income only increased about 7.6% in the recovery phase? What kind of real estate? Why is it different? Why were they 7 times more exposed than the rich people? Well, it's the type of real estate they were investing in. So the middle class, they owned a home, right? They owned a regular residential property, and a lot of people, they had other investment properties. So they owned maybe 1 other property, 2, 3 other properties. They were small-time landlords. Now the rich people on the other side, they owned a crap ton of real estate, but it was a different type of real estate. It was commercial real estate, and commercial real estate is really like a business that just happens to be tied to the land, right? So, if it's an apartment building, you have income coming in the form of tenants, you have your expenses, you have staff on site. That's a business. And that business just happens to be in the business of renting, units to people. Same thing with office space. Same thing with industrial, right? You own an industrial building. That's a business because you have your tenant that's paying you revenue. You have your expenses. Maybe it's Amazon. Maybe it's another, drop ship type of operation. That is your customer right there. That's very different from a residential property. So the middle class, they were 7 times more exposed to the housing bubble and the collapse. not because they were investing in real estate, because both sides, the rich people and the normal people, the average American, they were both investing in real estate, but it was just a different type of real estate that they were investing in. Today, we are facing another problem, not just the prospect of a recession, we are also facing inflation. Inflation is a huge topic right now, and it's a really big problem. And the central banks are trying to get this under control by raising rates. Like that's basically the only button they can push right now is raising rates, and that's going to lead us to some other problems down the road. Let's talk about inflation. So, what happens to the earned income when inflation hits? So, remember how we had the two graphs? We had the rich people, and we had the average people, and we had the chart that I just erased, even though I probably shouldn't have. So we've got investments right here. And then up here, the average people, this made up their investments right here. That was it. Everything else was earned income. So we can say, let's say it's like 95% of their net worth is through their active income, their savings, and all that stuff. What happens to this chunk right here when inflation hits 6% or 7% or 11%? What's happening? Well, if you have $100 and inflation is eroding 11% a year from your net worth, from your savings, you're losing $11. You've only got 89 cents left, or $89 left out of that $100. Every single year is chipping away, chipping away, chipping away. The rich people, on the other hand, because they've got about half of their net worth in investments act a little differently because it's an asset, and that's exactly what Erwin and I will be talking about as we come back in a little bit. We are going to be focusing on what you can do, how you can model the rich people and actually put your money to work in investments. So inflation, even though it's a really big problem, it won't impact you as much. It may actually work in your favor, and there's a couple different things that you can do to actually put inflation on your side, which is exactly what the rich people do, and not be like the average American in 2008, where you lost a quarter of your net worth, and then you didn't really participate in the upside of the market, the recovery of the market, and you were stagnating at 7.6%, whereas the rich people had 37% increase in their income. That is absolutely huge. So really looking forward to getting into this with Erwin as we get back. So I think the question is, what assets are you going to buy? What assets are you going to invest in so you can be like the rich people and not like the average person? Because I don't know about you, but I want to be on the rich column and not act like an average person and take a huge hit. Like nobody knows how bad the upcoming recession will be. There's a lot of forecasts in terms of it's going to be relatively mild, but nobody knows. All I know is I want to change my mindset and start doing things like rich people rather than average people on this side of the column. So a couple things, I'll go back over here to the chart. So a couple things I want to mention real quick. So we do have a contest on right now. So what I want you to do is like this video and comment. And once a month, we are going to be drawing somebody who likes one of these live streams and also leaves a comment. We are going to be drawing a loaded elite ticket to the Multifamily Conference coming up May 26th to 28th, 2023 with Grant Cardone, Alex Rodriguez. We are giving away a free loaded elite ticket. All you have to do is like and comment the video, and you can enter for a chance to do that. So make sure you like the video, make sure you comment on the video, and hopefully you win the ticket and you can come for free to the Multifamily Conference. So coming up right after the break, we've got Erwin Cito joining me. Really excited to have him on. So stay tuned. Don't go anywhere.